You're tuned back into Agriculture Today, and we continue our show and conversation with K-State grain economist Dan O'Brien and the senior economist at the IGP Institute, Guy Allen, as we discuss the grain market. Continuing our conversation, Dan, what are we seeing for wheat on the domestic side of things?
Coming out of that December 10th report, there were a few minor changes in the supply demand balance sheet. Basically the export projection for this year raised about 25 million bushels up to 850. So not a major change. A little bit of a increase of 5 million bushels in imports. Ending stocks now at projected to be 795 million bushels, and that's down 20 from the November numbers, but still up almost 100 million from the year prior in 23-24 marketing year. And price projection unchanged at $5.60. We averaged last year in 23-24 696, so still a sizable drop, $1.35 to $1.40 drop thereabouts. And as far as the world situation for wheat went, not a lot of major changes. Really the biggest thing that's noteworthy for wheat, I think, is in the broader macro sense, Guy, and I'll kick this over to you, in that world wheat ending stocks for the 24-25 marketing year of 258 million metric tons, pardon me, down about 9.5 million metric tons from the previous year. And we've got a whole lot of uncertainty about the Black Sea region, Russia, Ukraine, all sorts of things. Any thoughts and comments on that?
Yeah, just looking at the wheat situation, it was probably neutral. I'd say we're looking at big production. Going to have a record production again this year of wheat, but going to have good demand there as well. As you said, global ending stocks are up slightly, but there are concerns, particularly I think in Russia, in that Black Sea region. I would like to think that conflict's coming to an end. I think the thing that's really signaling that for me is sort of the collapse in the Russian ruble and the drop we've seen in that in the last 6 weeks, particularly. Sort of the events we've seen in Syria are sort of signaling some weakness there on Russia's part. So I'd like to think early in the new year we'll bring that conflict to some sort of resolution on that. That said, that's still going to be some problems. But that economic situation in Russia tied with the Ukraine, I think puts a bit of risk on top of that. That on top of the trade concerns, particularly for soybeans in China. Biggest question I've been getting is what's all this tariffs mean? And I think we need to move away from sort of the classical academic game theory sense of the impact of tariffs versus a more strategic application. And I think it can be quite effective in today's environment on that. But yeah, it was a bit hard to get excited about wheat prices, but I think it'll follow corn higher in the next few months.
And just on a side note, you're gonna, I think you'll talk more about currencies later, but if your currency is collapsing, if it's low value, that generally signifies in country high inflation, doesn't it?
Yeah, yeah. Well, yeah. You got probably 30% inflation in Russia at the moment. If you want to borrow money down there, it's going to cost you in the high 20s, 30% annual interest. You just can't do business there anymore. But that's exactly right.
Which means Russia has an incentive to come in with this new administration and probably end that conflict so they can try to right their ship. Is that?
Yeah. Well, just on the currency, the Fed's expected to cut their interest rates maybe 0.5%. Is that this week they've got a meeting? I think it's this week, or next week, sorry. But that'll help the U.S. economy a bit. We're currently seeing the U.S. dollar index above 107, which is fairly strong. It's been higher than that in the last couple of weeks, but that's a strong number. We'll see how the economists sort of move that forward. If the Fed drops the interest rate, that's actually bearish the dollar value. But I think it's a reflection of a lot of the other economies around the world are just pretty weak. And we've seen that reflected in the poor export demand last year. But with the supplies not there, it's going to be a problem. So we continue to see a strong U.S. dollar. The other economic indicator I like to talk about is your dry bulk index. that's a good leading indicator of the health of the global economy. We've seen that make some new lows here, couple year lows. It's down to 1100 this week. And the biggest driver of that is demand for coal and iron ore into China. And what that's telling me is that manufacturing sector is extremely weak as we see that dry bulk index come down. The other thing that does is it makes the U.S. Where it's freight disadvantaged into those high value markets into Asia, China, particularly competing with the Australians as well as even the South Americas. It lessens that disadvantage we have. Right now, U.S. corn's cheapest corn and cheapest wheat should be pricing in to a lot of those markets, and we're going to see good demand come out of there. So that transportation is working in our advantage. And that said, the Mississippi River has sort of solved itself for the moment. It's expected to maybe put some draft restrictions on by the end of the year a bit, but that supply chain's flowing quite well. And we've seen the cost of rail cars, particularly for Western grain belt, come back down to par, no premium on that. And that's sort of indicating we've resolved that rail car transportation issue with Mexico that we've seen with those border crossings.
And that transportation issue helps on soybeans, and we
Yes.
have had this last week, a little bit of weakness in soybeans, about 60 or so, 50, 60 million bushels preliminarily, but we have been running 88, 89. And really, when you look at the U.S. domestic supply demand balance sheet, there were no changes in that December report other than the price. And the USDA did drop their projected price from $10.80 down to $10.20. And as we talked about, that's where the lead futures contracts are below $10. And so that's kind of where all that's going to. And Guy, I would say that, so when we look at soybeans, and I'm going to set you up to take a shot at the USDA projections for 24-25 when it comes to soybeans.
Yes.
So there's a projection for world ending stocks to be up about 20 million metric tons in the 24-25 marketing year, but that's resting on the projection for a large Brazilian, especially soybean crop that we won't be harvesting until January, February, March, and beyond. So anyway, we've always got that timing issue, and frankly, the strength in U.S. exports going down the river system you're just talking about is we have a limited window until about January, February, especially when the South American supplies start to come. Comments, Guy?
Yeah, I'll sort of back into South America and the soybeans, looking at China. USDA left China's crush unchanged at about 98 million metric tons. Although they did increase their imports, they're expecting Sino Grain to buy a bit more soybeans into there. I think they're sort of front running the risk of tariffs coming on or a bit of a trade issue there. So we've seen some reasonable buying to unknown, but probably going into China on that at the moment, which merely makes me fairly optimistic. The other thing with freight coming down, we're just a couple dollars freight disadvantage going from Brazil through Center Gulf, still freight advantage off the PNW. So that drop in freights helped that as well. That sort of gives me an opportunity, I think, to talk about Brazil versus the U.S. when we talk about export competitiveness, and something that I sort of talk about increasingly frequently on why does the U.S. struggle to compete, and why are we the store or the supplier of last resort and the preferred storer of grain. And I think it's increasingly important to understand the market dynamics there. The global commodity prices price off Chicago and U.S. Center Gulf. And if a country like Brazil, Argentina, Europe, or even Australia on the wheat, if they want to move grain, they calculate the U.S. price and then discount their price a couple dollars a ton to the CNF final destination. If they don't want to sell the commodity or they're running out, then they price it higher than the U.S. The thing to keep in mind is the U.S. stores world supply of grain. Why is that? It takes four things to be a store of grain. First, you need short-term money to finance the inventory. Secondly, you need long-term finance to finance the construction of the asset of the warehouse you're going to store it in. And U.S. is fairly competitive, very competitive in capital markets around the world, particularly in countries like Brazil, particularly in places like Argentina, even in countries such as Australia.
So we can finance the equipment needed to store and ship.
Yeah, finance the inventory, finance the infrastructure. Thirdly, and most importantly, is the capacity to manage price risk from one season to the next. And we have an evolved, sophisticated futures exchange and derivative markets that lets the country elevator or the trade carry that inventory from one season to the next. And we saw that, if we remember the markets 3 months ago, just ahead of harvest, we saw very, very large carries for a number of reasons, expecting a big crop, neat, tight storage space, and the market was in big carries. Since then, we've got that market, that commodity put away. It's in store. We've seen those board spreads collapse. We've seen basis rally as transportation became loose, and the market's got to buy that away from the country elevator. So we have that market structure to manage that price risk one season to the next. And your country elevators should make a little money this year carrying that out. But they're not going to let go of that until they get paid a full season's return for storing that grain.
So, Guy, and we're just about out of time. We got just seconds. So, following what you said, we are, even though it's frustrating for our farmers, we're about the only major country in the world that has the storage and the finance and the ability to manage inventory. So what that means, when we get really high prices, it's probably more at the end of the marketing year when everybody else has shipped everything out. There's no place else to go, and the U.S. sitting around there with storehouses.
Well, we have an established market-based approach to do that. The contrast to that is China. And we always talk about the big inventories China's carrying. And in that situation, the government does all that. They do the short-term finance, they do the long-term finance, and the government is taking on the price risk. The other fourth key component in there is you need the human resource and the people skills to merchandise that and manage that. And that's very, very U.S. centric there as well. But at the end of the day, your exporting countries like Brazil and Argentina, they're going to price their grain and compete until they run out. So if you want to know when they're going to run out, take their monthly export capacity, divide it into their production, and they'll run out in that amount of time. And as their production increases, it just takes them longer to run out till that market comes back to the U.S.
Yeah. And Guy, I think we're out of time with that. Shelby, throw it back to you.
Dan, Guy, I appreciate you both taking the time to join us today and give us our grain market update.
Thank you very much.
Thank you.
That was